Good day, fellow chart watchers. It's Greg Schnell, and I am here with Martin Pring for Martin's monthly market roundup. Thanks for taking the time to join us. This market roundup finds us in a much different situation than the end of April market roundup, where we had been hitting new highs every week. And now all of a sudden we've had a 1 month pullback, and we're wondering where the market's going next. So we've got a very timely visit by Martin. He's just finished writing his intermarket review, which is his newsletter he's had going for 35 years. And Martin, are you with me?
I certainly am, Greg. It's kind of like when you get to the seaside and you see the tide coming in and then it starts to go out. And that period between the time when it's coming in and going out, it leaves you with a lot of confusion. That's the way I see it here.
Yeah, we're definitely mixed messages, and I'm sure if you asked every second person on the street, are we hitting new highs or are we going to keep going lower? It's a mixed reaction. So I'm excited to hear what you've got in your charts. What have you got for us this month?
Well, we've got a few. Let's just go first of all with the summary. And there we go. I thought for one moment the presentation failed me. So, number one, falling commodities and bond yields are warning of a probable extension to the growth slowdown. And the thing I'm keeping my eye on is Dr. Copper, because Copper has got the PhD in economics, because it often forecasts what happens to the economy. So we'll take a look at Copper in a little bit of detail. Some of the long-term equity indicators, which were bullish, and now reverting to bearish territory. So we're getting a very mixed picture. And I was saying earlier that it's kind of confusing. I guess we're supposed to have all the answers, but when the evidence is conflicting, we have to have a fairly even view on what's going on and what the outlook's likely to be, and what are the indicators that we should be watching to get us to that view. Number three, inflation-deflation relationships are tipping over towards deflation. That's things like commodities to bonds and inflation to deflation-sensitive assets and so forth. We'll take a look at that. Gold is testing overhead resistance, and we're doing this on Monday, the 1st of June. And just before I got onto the presentation, I was looking at what was happening to gold. And gold shares, and silver were all up sharply, but the other thing is they've been moving up with increased volume in the last couple of days. So we'll take a look at gold at the very end of this presentation, see what's going on there. Also, I think we're a little confused about what's happening with commodities, although obviously they're in a bear market. But if we're going to see a change in that bear status, one of the things to look for would be a reversal in the Canadian and Aussie dollars. Because they are very closely tied into the commodity markets on a long-term basis. So let's get started off with a look at the global index now, the World Stock Index, the MSCI ACWI, and comparing that to the global momentum indicator as put out by the OECD. It's a leading indicator of the global economy, and the stock market's very much tied up with it. The idea here is that we've got these green vertical lines which mark the cyclical lows for the global economy. And what happens when you get one of those cyclical lows is typically before that happens, you get the stock market coming down, as you can see with that red arrow. And I can do that with virtually every cycle since the late 1960s, that we've had the economy come down and stock market come down and anticipate that. When the economy turns around, you get one of these green vertical lines. And if you look to the right of those green vertical lines, you're going to see that the stock market responds to that, generally speaking, in a very positive way. So right now we have the global stock markets really being in a discounting mechanism again, because it's peaked in January of 2018 and made a series of two lower peaks since then. And you can see what it's been doing. It's just been anticipating, just as it usually does, a decline in this global economic leading indicator. Now in the latest data, which only unfortunately comes up to March, but we can see that it was flat in March compared to February. So it's for the first time since this decline started, the global economy is starting to move a little bit to the unchanged business, And maybe that will be a move to slightly higher. We don't know until we get that data, but it is kind of interesting. It's already at a, I won't call it an oversold level, because you don't call economies oversold, but sort of partially overstretched on the downside. And so it could, and when it's got down there before, in this particular recovery, since the last recession, it has usually bounced at this level. So we're at a kind of a critical point here. It's going sideways, and the stock market's really going sideways too, but it's kind of been discounting what's already happened in the economy. So it's going to be interesting to see what happens to the global, to this particular indicator as we move forward. Now we're looking at the US, and we've got the S&P in the top panel, and underneath is a leading indicator of the economy. This is the ratio of a coincident indicator, non-farm payrolls, to a lagging indicator, the unemployment rate. When it's moving up, it's bullish for the economy, and the red highlights represent recessionary periods. And the vertical lines, the vertical red lines, represent the onset of a recession. And if you look at one of the reasons I like this indicator is that it consistently calls recessions as you draw and see a trend line violated. So it's a very deliberate kind of indicator. It's not jagged in any way. It's fairly well controlled. And when you can draw a trend line, which is in virtually every cycle since the 1950s, and that trend line gets violated on the downside, that typically is the start of a recession or a couple of months before a recession. And one of the problems, though, is that drawing a trend line can be a little bit subjective. And we can certainly draw one in the current cycle. The ratio made a new high, so there's no sign of weakness here in terms of the absolute numbers. But when you look at the indicator in the bottom panel, which is a little bit more objective at measuring where you're going to reach a recessionary inflection point, it started to rally from this red line here, which is slightly below zero. This red line is what I call the recession line, because every time it gets down towards it, that signals a recession. You can tell that by looking at the red line and seeing that that's the beginning of a recession, both here and here. So what we've had is some deterioration as the slowdown has materialized since for the last year and a half or so. And now it's started to bounce off the red line. And in the past, we get one of these green arrows when we bounce off the red line and move higher. And that indicates, historically, that's indicated that you haven't morphed into a recession. You actually moved into a new recovery phase as the slowdown is over. So we've seen the slowdown here, and we're seeing the bounce on the recessionary line. So that's hopeful that we're going to emerge from this slowdown and not morph into recession. Now, if this indicator starts to turn down and now crosses below zero, kind of like it did in 1989, 1990, that would be a negative from the point of view of expecting a recessionary condition and not a recovery. And if that would have happened, given the relationship between stocks and the economy, I would expect to see the stock market move lower. But if it can bounce from here, that's very encouraging. Now we're looking at the world index again. This time we're looking at a global diffusion indicator. It monitors the percentage of a basket of local currency indexes that are above their 18-month moving average. That's what the 18 stands for. And that data is pretty jagged, so we smooth it with a 6-month moving average, which is what the 6 is for. And the idea is that when we get a sell-off in the indicator and it starts to turn up again, that's when we get one of these green vertical lines. And the green vertical lines represent signals that have resulted in, been followed by a rally, so they're successful signals. And the red vertical lines represent unsuccessful signals. And as you can see, we got an unsuccessful signal in 2002, but by far the majority of these signals have been positive. Now, last week, at the beginning of last week, this indicator was bullish, but by the end of the week, it had turned down again and just couldn't quite cross above its moving average. So to me, that sort of is indicative of what I was saying before, that we're in a very finely balanced situation here in terms of a lot of different relationships in the market and, of course, the economy, as you could have seen from the previous chart. There have been a couple of instances where we've seen false signals before, like this one just here very quickly, and the market went sideways, and this one here in 1982 was just had a little bit more downside on to materialize before we could see a bottom. So we're already reasonably oversold here on this indicator. So it's possible it could come down here without doing too much damage, and then we see a reversal. But right now we can't say this indicator is bullish because it hasn't reversed. Now looking at a CRB spot raw industrials and a long-term relationship between government yields and BAA yields, corporate BAA yields. It's a credit spread, but it's not the actual credit spread itself because that wouldn't tell us very much. What this is a momentum indicator, a KST of that relationship. So when the KST is moving up, that means that investors are gaining in confidence, and when it's moving down, that means they're losing confidence. And the green vertical lines represent, or actually all the vertical lines represent the low periods and the reversal periods to the upside in the KST. The green vertical lines represent successful signals where either the commodity market moved up, or in the case of this signal just here, it moved sideways for a while. A while in this case here doesn't look very long, but that's nearly 2 years, from 96 to 97. So a little bit of space in this chart actually corresponds to quite a long time period. So the vertical lines showed it in virtually every situation. Either the commodity markets went sideways or they went up. There's a failed signal in 1980, and a couple of whipsaw signals enclosed in these two ellipses here. So right now the indicator is coming down. It's not deeply oversold. It's moderately oversold. It could start to turn up if we could see some potential for it to reverse on the short term. But that is what we're going to have to wait and see happens. But this relationship here is kind of difficult to follow. But this green line here represents a similar relationship between the HYG and the IEF. That's the iBoxx high yield versus the iShares 7 to 10 year treasury. And that, of course, is something that we can follow on StockCharts. But before I get to, I've got a chart of that. But before I get there, I want to just point out where we are again at a very crucial point here, because here's the CRB spot raw industrials, and it's just broken slightly below this support trend line, not decisively, but it's definitely broken. And you can see that the ratio, the credit spread ratio in the previous chart, moves up and down pretty closely with what's going on with commodities. That ratio right now is right on this trend line here. So that, I think, is very significant. If it breaks through the trend line and this CRB spot breaks a little bit lower, then that would indicate that there's going to be a bigger down leg in the commodity markets than we're expecting right now. So I said you can follow this on StockCharts, and here is the ratio, the HYG versus the IEF. And what we do is we put an underscore in front of both symbols, so we take away the interest payments or the dividend payments, because obviously if we're including the interest payments, HYG is going to outperform the IEF. So we want to take that out so we have a purely price signal. This time we're not looking at CRB spot raw industrials, which is purely industrial commodities. We're looking at the more broadly based CRB composite, which also includes a big weighting for energy and obviously has a lot of agricultural products and things in it. But you can see once again that and a gaining in confidence means the HYG is beating the IEF. In other words, people are going for yield, they're not worried about safety. And when it comes down, that means people are more worried about safety. And if they're worried about safety, that's because they're afraid that the economy is going to result in, or it's going to get weaker, and it will result in more defaults. Well, you can see with these arrows that these two series move pretty closely together. And right now, the CRB composite, just like the CRB spot raw industrials, is flirting with this support trend line. In the case of the CRB spot, it had gone through. In the case of the industrials, it's right on it. And the ratio of the iBoxx to the IEF is also very, as of today, it went very, very slightly below the line, but nothing that I'm going to get terribly concerned about, because this is only Monday and this is a weekly chart. So that's the other thing. But if we're going to bounce here, and this indicator reflects what goes on in the economy, and the economy is kind of in a a no man's land here. It could easily go in either direction. This is something we want to watch very closely, because if it breaks to the downside in a very serious way, that's going to reflect more concern by investors about the state of the economy. So that's something we want to watch pretty closely. I mentioned about watching Dr. Copper before, because copper is in a very interesting point here. Got two series in the top panel here. One is the CRB spot raw industrials, and the other is high-grade copper. We go back to the 1960s on this. And you can see that most of the movements that take place in the CRB spot raw industrials also reflected in the copper price as well. So, and the same thing with the momentum here. That's what these green vertical lines sort of kind of showing you when the momentum of both series sort of bottom out more or less simultaneously. So right now, what we've got is both series are declining. And last month, the copper indicator, or KST, started to, I should say in April, it started to try and turn up. And then in May, it started, it sort of ticked down a bit, which is not too encouraging. I don't like to see these hesitations take place. But long story short, what we're seeing here is the copper price is resting on this trend line here. This trend line goes all the way back to 2002, 2001. So it's nearly 20 years in length, a secular uptrend line. Very, very significant. Should be a good area of support. So just as we saw on those confidence ratios in the previous charts, that we're at a critical point, we're also at a critical point for copper, because it's not only is it on its secular trend line, but it's also just slightly above this line here, which is the neckline of a potential head and shoulders top with negative momentum. So we'll take a closer look at copper. We move on to the StockCharts platform. Actually, we won't look at copper. We'll look at the DB Base Metals Fund, which is a broader measure of base metals, and also has the same economic implications as bullish copper or bearish copper. And then before we move to the StockCharts platform, I'd like to show you a diagram, which I've started showing every month now, of where the various sectors are in terms of their long-term KST. And I just noticed I made a real blooper here. This says short-term KST. It should be an indication of a long-term KST, because that's what we're going to show in the next chart. But the idea is that we split the long-term KST into four quadrants. The fall, when it's above zero and falling. The winter, when it's below zero and falling, which is when we get everything into this position here. That's the most positive we can get, because the next is when the groups move into spring, when it's in a rising phase, but still below zero. And then summer is the kind of the market phase when it's rising and above zero. So we look at this diagram now, and bear in mind where all these various sectors are going to be on this chart here. So there's the fall, there's the winter, there's the spring, and there's the summer. So now, first thing we look at is where currently the bonds are. And the bond prices like the TLT or something like that is at this point here where it's ready to take off still more on the upside. Now, it could go up for a little while and then start to turn down. We have no idea, or go up a lot and come down. We have no idea how long the bull market's like to last. But certainly if we want to buy bonds, we want to see them down here rather than up here turning down. Now, a funny thing happened to stocks. Last month, the S&P had just started to flatten out, and I was able to put it over here into the summer category because it had moved from fall to summer. But that was a very anemic move in the S&P, and it's now actually reverted back to here. Several other indicator sectors last month were also over here, and now they move back. So let's take a look as we move through. First of all, let's see what industrial commodity prices are. They're down here, getting ready to start to turn around to go to the upside. And if you remember, that's the way the CRB spot raw industrials was with several of the indicators that we follow. So now we can look at, we're going to split it into early cycle leaders and late cycle leaders. So let's put the early cycles up. So things like electric utilities, REITs, telecom, home builders, staples, all those are on the right-hand part of the chart, which is where we want Ideally, we want everything to be over here. But some of them, like consumer discretionary, last month were over here, and now they've transferred back to the fall. So what that means, when you look also at the lagging indicators, things like industrials, materials, metals, technology, oil and gas, and so forth, they're on this side of the bell curve. Last month, they were on this side, and that suggested to me that we were going to see some upside movement in the stock market. Now they've moved back here. It suggests to me that we're going to see some more corrective activity. Now, corrective activity could either mean they come down, or it can mean they go sideways, but it means that they're unlikely to go up because they've already experienced, some of these have already experienced the forced move to the upside, as I kind of indicated with this little slight movement into here. So that we've kind of set back a little bit this month over last month because a lot of these groups have moved back into their previous trajectories. So now we're going to move over to the StockCharts platform. Let me just get this over. And this is the moment of truth. I guess it's coming up, is it, Greg?
Yeah, I can see that.
Wow, that's a relief. Okay, so here we are. Look at the S&P now. Look at the stock market first, and then we'll get through to look at bonds and so forth. And in the stock market, what we're seeing is the S&P broke this big uptrend line, and when we saw the rally into April, it just got to the line and found resistance and moved back. Now it's below this red line, which is the 12-month moving average. And you can see the KST is still declining in that fall position that we talked about before. And now looking back, you could hardly discern that tick up that took place, or the flattening that took place in April. So now that's on the downside. Let me just get into the view all mode, and we can move forwards then. I think we can move forwards. There we go. Okay, so here's the S&P again, and underneath is the PPO. And we're looking at the parameters of 6 to 15, where we divide a 6-month moving average by a 15-month moving average. And the green vertical lines show reversals from at or below the blue dash line. There's the blue dash line, there's a reversal, there's a green vertical line. Red vertical line shows when the situation did not work out as expected. So they were in the middle of a bear market, didn't cross its 12-month moving average, looked like it was a buy signal, and then it reverted to the downside. That also happened back in 1957, where we get a similar result of a false signal. But by and large, when this indicator reverses from below the blue line, you get a green vertical line, which basically means it should be followed. The chances are it's going to be followed by a bull market. We had 22 signals, 2 of which were failures. So that's pretty good odds. That went bullish a couple of months ago, it rallied, and now it's pulled back again. So we're in a kind of a no man's situation, again, pointing out this idea that we're in a very fluid situation here. It could go in either direction. And these are the kind of indicators that are going to point us in that direction when it finally moves, either to the downside or the upside. Next chart shows again a little bit of confusion. This is the S&P versus the CRB composite, and this is the KST of that relationship. So when it's moving up, it means that stocks are outperforming commodities. When it's moving down, it means they're underperforming. And once again, the green vertical lines represent the periods when the KST of this relationship, stock-commodity relationship, starts to turn up. There's 16 signals since, when are we starting? In 1960. 1 failed, 16 were successful. So it's a pretty high odds of success. And we got a buy signal 2 or 3 months ago here, but it's not yet turned into what I would call a decisive here. It's like going above the green line. I think I'd get a little more excited. But at the moment, it could easily, if we got a decline in the stock market and some of those confidence ratios start to break, we could see this indicator move to the downside. So again, steady, sorry about that. Let's go back. Here we are. Okay. Now, this is a chart I put up last month. It's the Dow Jones World Index, and it goes back to 2000. The pink shaded areas represent bear markets. which we know from the benefit of hindsight. We're not using any indicator to determine this. We just look at the top, look at the bottom, and then drawing the shaded area. But the reason I put it up was because you can roughly look in the pink shaded areas at the characteristics of this 14-week RSI, and it doesn't go above this green line at 65. And the same thing happened in the next bear market, 08 to 09. And the same thing happened in the 14 to 16 mini bear market. And when it did go above that 65 level, that's when we got these green arrows. So in these green arrows tell you that the characteristics of the RSI have changed, and it's now in a bull market characteristic. So there was the signal there. There was the signal there. And then in the next one, you just got to 65, touched 65, and you got another buy signal here. So it never quite made 65 in this current cycle. And so maybe the next time it rallies, it can move up through the 65, indicating that we have a bull market characteristic. And if that were to happen, and it broke above this line here, obviously that's potentially a reverse head and shoulders. There will be the shoulder, there will be the head, and wherever this decline ends would be the right shoulder, provided, of course, it moved up above the 400 level to a new above this trend line, resistance trend line. So that's something we're going to be watching very closely to see where, if, as and when that happens. It will happen. It's a question of when we can get a bull market signal. This chart here is one that's been worrying me for a while. I wrote about it, I think it was last week or the week before last. It's the NASDAQ compared to the NASDAQ bullish percent. And what we're seeing here in a lot of situations is we get the NASDAQ makes a new high, but the bullish percent also makes a high, but it doesn't confirm that high in the index. And we see the same thing over here in August, September, and then a lower high in the bullish percent. What that's telling us, of course, is that as the market makes its way higher, there are fewer and fewer stocks that are participating in terms of being in a bull trend. And when we get a trend line break in the index, and we get a similar trend line break or a different kind of trend line break in the bullish percent, then we have the two things confirming, and that becomes our warning signal. Then finally, we have the same sort of thing here between February and May, where the bullish percent makes a lower high, and the ratio itself makes a higher high. Now, the really big divergence here, of course, is that the NASDAQ made its high here, or a high here, made a higher high here and a higher high back in May. And the bullish percent made a series of lower peaks for that whole period. So that's a very concerning negative divergence. We also see the same thing when we look at the NYSE versus the S&P. And when we look at the world index versus the S&P, because the NYSE and the world index made their peak in January 2018, and the S&P made its peak, was it September of last year. So there's another potentially large divergence. I would like to see these divergences get confirmed with a trend break. And unfortunately, the things have been so volatile that there's no really good trend line that you can draw for the NASDAQ here or for the S&P. So now we're looking at some inter-asset relationships. We're looking at stocks versus bonds. When this the ratio is rising, it means that stocks are outperforming bonds. When it's falling, it means bonds are the king. It doesn't necessarily mean when it falls that stocks are falling, and it doesn't necessarily mean when it rises that stocks are rising, just that stocks are outperforming bonds or underperforming bonds. Well, remember I was saying we're on the brink. There's a lot of markets that are on the edge of a dam bursting. And here's another one. This ratio here is right at this trend line going back to 2016. And it looks to me like it's likely to break below the trend line. And the reason for that is not so much because the KST is in a downward trajectory. It's fairly overstretched, so it may not go down much more. But I'm more concerned about this indicator in the middle panel, the special K. And for those of you not familiar with the special K, it's a momentum indicator that just combines a short-term KST with an intermediate with a long-term KST, all into one indicator. So the indicator itself really reflects these very long-term swings in momentum. And yet, because it includes the short and the intermediate time frames, it's very jagged. And it tends to peak and trough most of the time with the market that it's following, or the price that it's following, which is easy to spot with the benefit of hindsight. I can see there's a low here, for example, and there's the low there. And you can see there's a high here and a high there, and the same thing over here, a high here and a high there. So obviously, in the benefit of hindsight, you can see that. And it happens about 70% of the time that the two things line up. And they usually line up within a week or two or less of each other. So the idea is to kind of figure out when a special K, excuse me, reverses direction. And I'll do it a number of ways. One is by looking at when it crosses its signal line here, which is a 100-day moving average of a 100-day smoothing of the actual data. And another, which is fairly obvious on this chart here, is when we draw a trend line. And when the trend line and the moving average or the signal line get violated at a similar time, that tends to reinforce the signal as a valid one, increases its odds of probability. Well, we got a sell signal on the momentum indicator back here late last year, and it's been in a downtrend ever since. And you could have drawn a trend line here for the special K itself. But now you can kind of draw another trend line here, which kind of marks this sort of head and shoulders. There'd be the shoulder, there'd be the head, there'd be the right shoulder. And the last couple of weeks, last week, it's broken decisively below that trend line. And I have a rule that says, and it doesn't always work out, but it works out most of the time, that wherever the special K goes, the price will usually follow. So in other words, we've made a new low here, chances are we're going to make a new low here in this relationship. So what this is telling me is that the trend right now is favoring, which is fairly obvious when you look at last week's price action, and that is that the trend, the ratio of stocks to bonds is moving in favor of bonds. And of the two assets, bonds really at this point in time are the preferred asset over stocks in general. And it doesn't mean that the bonds are superior in their performance against all assets. They're not doing, for example, their utilities occasionally, when interest rates are falling, will outperform bonds and so forth. But we're talking about the stock market itself. In other words, the aggregate of all the sectors made up by the S&P composite is going to be outperformed by bonds. Overdone maybe for the time being, maybe bouncing this trend line a little bit, but it does look to me as if the bonds are going to outperform the stocks over the next few months. Another indicator, which is a kind of a confidence indicator, is the relationship between stocks and gold. That's shown in the bottom window. When a ratio is rising, that means that stocks are outperforming gold. When it's falling, it means that gold are outperforming stocks. Usually when stocks are outperforming gold, that's bullish for stocks. And as you can see from this green shaded area here, and this green shaded area, again, it's been drawn with the benefit of hindsight, looking at extended periods when the stocks are moving up against gold. When gold is outperforming stocks, stocks don't always go down. Sometimes they go up like this. But usually if they're going to be vulnerable, this is the environment in which it's going to happen. So right now we have a relationship where the relationship between stocks and gold is below its 12-month moving average. And it's made a lower peak, which is not a good sign, whereas the S&P made a higher peak. So all these letters here, numbers I got 1, 2, and 3, they all represent divergences at the top of the market, where the stock market ratio against gold was not able to confirm the new high in stocks itself. So that sort of indicated a very subtle indication that people were losing confidence and kind of moving towards gold. So on both these occasions in the past, we've seen the ratio lead the actual index lower, and we're seeing the same sort of thing happening now. Although we're not seeing it move lower at this point, it is definitely a negative sign. If you go to the next chart, we see the same ratio. And what's the ratio? What's it done this time? Is stocks against gold, create a head and shoulders top. Obviously a bit overdone on the downside here. But it does appear that gold is going to outperform stocks, or stocks are going to underperform gold, which is not necessarily bearish for stocks, but it's certainly not what we want to see it going the other way to be positive about stocks. We talked before about some of these confidence ratios, I looked at the HYG against the IEF, the iBox high yield against the 7 to 10 year. Now we're looking at it against the 20-year plus, the TLT. And whereas the IEF ratio was up here somewhere, the TLT is definitely broken below its January low, which is not a good sign. It's not an immediately bad sign for stocks because you can see in this period here, what's that, 2017, the ratio was zigzagging its way down, and that didn't preclude stocks from going up. But the longer this relationship gets out of kilter, the more potentially negative it becomes, not only for stocks, but for the economy as well, and therefore for bond yields. Once again, one of the reasons I think this ratio is going to continue to get worse is because the special K has broken this trend line here, and that trend line goes all the way back to 2017. So it's about a two and a half year trend line or so. And it's just broken. It's made a new low. Remember the rule: where the special K goes, the price usually follows, and the price in this case would be this ratio here. We move on from that one onto the next chart because I'm getting a little bit behind, I think. So now we're looking at one other relationship. This is financials versus bonds. When financials are beating bonds, that's usually good for stocks. And when bonds are beating financials, it's usually not so good for stocks. And you can see that ratio is again right at the edge of a potential cliff of a head and shoulders neckline, just like so many indicators that you're seeing during this presentation. One area of that looks good to me, at least in a relative way, is the so-called Pring deflation group index, and it is an index made up of several deflation-sensitive sectors, things like casualty and property companies, electric utilities, banks, and so forth, all combined into one indicator. And you can see that made a new high recently, a significant new high. But look at the relative strength of this relationship against the S&P. It's just broken this trend line going all the way back to 2005, and it's broken it decisively. So what that's telling me is that if we're going to be in the stock market, the place to be will be in these deflation-sensitive areas. And you remember from our schematic diagram we saw in the the end of part one of the presentation, the sectors that were looking good from the point of view of being on the right-hand part of the diagram in the spring and in the spring and summer positions were things like utilities, which are included in this indicator, the REITs, and other leading indicators, defensive leading sectors. Also, the other thing to take away from this chart is the KST has started to turn up from I would say a low solid situation, but from a neutral level. So that suggests that it's got plenty of power to go up before it gets into an overbought situation.
Hey, Martin, I have one question on that. You know, on this winter, spring, summer chart, did you use weekly KST locations or monthly?
Well, actually, I use daily using monthly time frames. So it's the equivalent of monthly because I want to know what's going on to that stuff in mid-month. And that's why I use the daily. So effectively it's monthly, but
okay.
We're actually using daily data.
And do you find weekly too whippy or just?
Well, no. If I do daily, every time I update my database, then I can update these charts if I want to. If I do monthly, then I have to wait till the end of the month or put them all in manually estimating where they are. So that's why I take the daily.
Yeah, I run a bunch of different scans just trying to see the relative location of the PPO, the percentage price oscillator. So, but I haven't drawn it out the way you did. So I think I might have to do some homework and try and set that up and see how it works and see if it compares with the way you're doing it. So I'm interested to see that, but thanks for the idea. Those are, and again, like you're seeing these certain groups of stocks starting to break out and behave differently than they have for a long period of time. I think that's pretty critical data.
Because if I was smart, I'd do it in StockCharts because it's automatically updated there. That's what I'm going to do next month.
Okay, so it's good.
Okay, so the last stock chart is this one here. This is the S&P versus the EFA. In other words, the US market against the rest of the world. It's in a bullish trend because the long-term KST is bullish and it's above the 65-week exponential, which is this one here. But you can see it's kind of struggling a little bit and it's broken decisively below this trend line. So that suggests that maybe, and you can also see that the short-term KST experienced a negative divergence with the price and has now gone bearish again. So maybe that's kind of hinting that the rest of the world may begin to start to outperform the S&P. And if that were the case, I think the reason for that would be that the S&P has a weighting of technology stocks. And if you're looking at what's going on today in technology, they were very, very weak. I didn't get a chance to compare them to everything in the stock market, but it seemed to me, and maybe you watching it too, Greg, that the technology stocks were one of the weakest sectors. And that, since it has a fairly good weighting in the S&P, that could be the reason why the S&P was outperforming for so long and why it may be turning now. I don't know. I'm going to have to look at that in a closer.
Yeah, I think you're right, and I think almost every one of those large techs was getting discussed as either a Department of Justice or for investigation or antitrust violations or whatever. So, yeah, there's a whole host of issues there in that tech sector, and I think they're the largest group in the S&P. So they would definitely drag down the S&P. But even the financials are pulling down hard, but it's they're pulling down hard all over the world. So I think it's got to be the technologies that's causing this chart to crack.
Yeah, yeah. So now we look at bonds. This is the 10-year yield, goes back to 1970. You see the peak in September of 1981 with the zigzag down in the secular bear market with a possible end to it in 2016. Shorter-term maturities look like they bottomed in 2012. So it depends on which maturity you have, where it could have bottomed. My working scenario is that we are in a trading range. Just like we were in a trading range at the peak and we were a trading range at the 1940s type bottom, we're in a trading range now. And this decline we're seeing, which was signaled very nicely by the KST here, by the way, is indicative of another move to sort of enlarge this base. So when the secular trend actually does take off on the upside, it would have formed a nice big base, just like it did in the 1940s and the 19-teens. So we'll see what happens. So right now, obviously, that trend right now is a bearish one, a primary bearish one. And that's not just so true in the US, it's true around the world. It's the 10-year in the US, the UK is the next panel down, Germany is the next panel down, and the Japanese JGB 10-year is the next panel down. They have one thing in common, all the yields are breaking down. So it's not just happening in the US, it's happening worldwide. And when something happens on a worldwide basis, it tends to have a much stronger trend than if it's just one country which isn't doing it in isolation or 2 or 3 countries doing it in isolation. So global interest rates are agreeing with what we're doing over here. The interesting thing that surprises me is the Fed's sort of keeping rates fairly steady. Here's the 1-year Treasury, and it's broken below its 12-month moving average. I put in these red arrows to show you what happened before when these 1-year Treasuries broke their 12-month moving average. There was a decline of some nature. Sometimes it's a relatively small and short decline, although that's a 2-year decline, this one here. And this one here was 2001 to 2003. So it can be a fairly long decline. We don't know, of course, at the time. But the fact is it's a decisive signal, which suggests to me that short rates are in the process of coming down. And we don't know it yet, but I wouldn't be at all surprised if the Fed were to lower rates. If they don't, then they're ignoring market signals, and that could happen to what happened to them in December of last year, when the stock market, when they weren't going to lower rates, were thinking about hiring rates, and then they decided not to hire rates when the stock market fell out of bed. So they may react to that. So we have to watch that very carefully. So here's the 10-year yield. It's completed this head and shoulders top. It looks very overstretched on the downside, but look at the 3 KSTs, they're all on a down move. So I'm not going to stand in the way of a freight train here. Sometimes I need yields move down. They really collapse pretty fast. Here's an interesting indicator here. This is the KST in the bottom window. But underneath is another one, an indicator I haven't had a lot of experience with, but I'm kind of impressed with the way it behaves in this chart. This is the Bollinger Band width indicator, which measures the width between the Bollinger Bands. So it's it kind of measures the momentum of volatility in a way. And the idea is the red lines represent bearish signals when the market's oversold. The Bollingers increase too much to one side on the upside and start to turn down above this blue line. And the green represents buy signals when the market's oversold and we get a reversal on the Bollinger width indicator. So right now we're waiting for a bullish signal because the market's oversold down here, or moving towards oversold with the KST, and the Bollinger Bands are well above the blue line. So when they start to turn, we don't know when they're going to turn. I mean, they could go up as high as they went in these periods here. But it's something worth watching. For when that reverses and the KST reverses, you'd have pretty good odds that you'd seen the low for at least this move anyway. So when we're looking at commodities and when we're looking at bonds, we have to compare them with commodities. And in this case here, we've got the commodity bond ratio. So moving down is when bonds are outperforming commodities. It's deflationary. When it's moving up, it means that commodities are outperforming bonds. We see a very nice trend line here going back to 2016. Hit it once, twice, three times. Now it's penetrated through, which is a deflationary signal. We also see the special K here has broken its trend line here, so we have another deflationary signal. But look at what's happening to the KST. It's starting to flatten out. It's still bearish, but it's flattening out. And the special K could fairly easily, if this thing starts to turn around, it's possible that this could be a bear signal. I would treat it as a bear signal if it were to break above this downtrend line here at 1.7. That's the ratio of the CRB versus the IEF. But right now, all roads are pointing to the south, but not that decisively. So I'm just going to move to the third panel here. And here's the CRB on a monthly chart this time. This time we're looking at an 18-month rate of change. And I put this chart up just to show you that right now the CRB is in a bear market, or you could say a trading range since 2018. But it wouldn't take much to turn it into a powerful bull market, because sometimes when you can draw a long-term trend line, and this is a long-term trend, so since 2008, that's 11 years on the rate of change, the 18-month rate of change, and this line gets violated, and you can draw a similar line on the price, and it crosses its moving averages, and it crosses the trend line. You get some pretty strong signal of a major reverse on commodity prices. So, well, commodities are weak right now. They're in a bear market, and I'm certainly not saying they're going to be in a bull market. What I'm saying is it wouldn't take a lot to turn commodities into bullish mode. So again, it goes back to the idea I was saying about how confusing things are, because nothing is really decisive here. And if the economy is in an indecisive manner, it could mean it could renew its growth and continue and make it the longest recovery on record, or it could kind of slowly but surely morph towards into a business contraction. So all this is being expressed in this market activity. So that's the same thing here. This is the DBC, the Commodity Tracking Index, Invesco. Not much to add there. I mean, once again, you can see this declining trend. The KST is bearish. So everything right now is looking bearish, but it wouldn't take that much to turn it. This is an interesting chart here. This is the DBC in the top panel. And underneath is the relationship between gold and the DBC. When it's rising, it means that gold is outperforming the DBC. So when this relationship is rising, gold is outperforming the DBC. Gold is outperforming commodities. And what happens to commodities? Even though this is a relative relationship, what happens when gold goes up is it's really people moving into safety, because they are moving out of commodities. Commodities go down. And when the gold is underperforming commodities, people are becoming less concerned, they're becoming more confident, and commodities move up. And you can see this opposite movement, inverted movement is happening all over the place, virtually every time. Here's the low in the ratio, and there's the high in commodities. There's the high in the ratio and the low in commodities. So it's really interesting. So how do we qualify this? Well, the next chart tries to do that. we're looking at the same three series, the DBC, commodities, gold against commodities, and then the ratio, the KST for this relationship. So when the KST is moving up in terms of gold, beating commodities, that's when we get one of these pink shaded areas. And look what happens in the pink shaded areas. We get a decline basically in commodities, or a sideways movement. And certainly since this indicator has been moving up here, the KST, we've had a decline in commodity prices. So right now, once again, looking at these very, very important trend lines again, we're right at the cusp here, where the gold to commodities is right at this trend line. And it's a good trend line going back to 2016. It's been touched a number of times. And commodities themselves are at a trend line. So if the commodities were to break and the gold was to break against the commodities, that would be the two things confirming each other. Something really important to watch, I think, if you're interested in commodity prices. I mentioned before we want to watch Dr. Copper. Here's the base metal index, the DBB, and you can see that it's on the edge of a head and shoulders top. The little green arrows that represent here, something worth watching, is every time we come down to the 200-day moving average, you get these green arrows, or every time we come up to one of these, up to the 200 moving average, you get a red arrow. And you can see all the way through, it's actually a very, very important turning point for both reactions and rallies. And then the solid arrows show when we actually get the solid breakthrough. So there's a solid breakthrough, and up it went. There's a solid breakthrough on the downside, and there it went down. Not much of a signal there, but now we've got another sell signal. The DBB is right on this neckline of his potential head and shoulders. KST is flattening, so once again, it may bounce in this support level. And if it were to get above the 17 level, that will be very, very positive, not only for base metals, but for commodities in general, remembering how the copper price works in conjunction with the CRB spot raw industrials, and for the economy, because the commodities are not only a forerunner of inflation, but they're also kind of a mark-to-market indication of what the economy is doing. So a couple more charts here. Just want to show you the agricultural, the DB Agricultural Fund, because it's been in a very long-term move down since 2008. That's when it made its secular bull market. It experienced an outside week a few weeks ago. That's not enough to turn the whole thing around, but it does. Usually when you get an outside bar, it indicates that the prevailing trend is going to stop for at least 5 to 10 bars. In this case, it'll be 5 to 10 weeks. And that, if that were the case, that could be enough to get the agricultural index or price moving up on a primary trend basis. So here we're seeing the same indicator now. This goes back to 2014. Remember that bear market began in 2008, so this is only a part of it. But here's where the signal, I would think, would come with agricultural commodities. If they break above the 65-year exponential moving average, which you can't see because it's below this trend line. That means they reinforce each other's resistance level. And this horizontal line here, which could mark the bottom of the top of a broad information with a flat top. In order to do that, it would have to go straight up through. It can't come up and then bounce back down and form a right shoulder. It would have to go straight through. If that were to happen, that would be very, very bullish for commodities in the agricultural sector. And as you can see, the ROC here, the 13-week ROC, has already broken above this trend line here. So one final commodity chart to show you, and that is corn, and it's impressed me immensely because it's broken out of this nice base here, 2014 to 2019. Good decisive breakout, suggesting corn prices are headed higher, right in the middle of the trade dispute. I think I'm going to stop there, Greg, and turn it over to you and say to you, if there's anything that you're looking at, or what would you look at to suggest that we're going to get out of this dilemma of a confused kind of economy?
Well, the one concern I have is all of the global PMIs continue to drop, and I think, I looked last night at Asian markets, and they had all dropped. I think they're all decisively below 50. Yeah, that's the Purchasing Managers Index, and I think the U.S. one slowed down a little bit this month, but still wasn't as negative. But I saw some Dallas manufacturing data from the middle of the month, and it was pretty horrific. So I keep seeing a slowdown in all of these purchasing managers indexes globally. I keep seeing these European financial charts breaking down. And, we've got about 4 minutes left, but the one thing that I'm seeing over and over and over again are these important sectors continue to break down. So industrials breaking down. There's a triple top on XLI. The financials are rolling over. The commodities are pulling back hard. I like to think of oil as an economic indicator. It literally left $66 behind and is, in the 53s and 52s. So I'm seeing everything globally slow right down here. And I just have trouble believing that especially with tech getting hit, that there's any quick remedy to this unless, something starts to improve on that front. What do you think?
Yeah, I think you're right about the tech. One of the indexes I've been following is the dollar DJ Ecom, ECOM, which is the e-commerce index.
Yeah.
And it got drawn to my attention by Jeffrey Gundlach, who's the bond guru.
Yeah.
And he was pointing out that it was the biggest bubble, one of the biggest bubbles we've ever seen, because it went up, I forget, 10 or 12 times or something. Just because something goes up 10 or 12 times doesn't mean to say that it's going to turn around. But it does indicate that there's probably a lot of careless decisions made there, and the psychology has probably reached some kind of extreme. And of course, that's kind of the backbone for some of the NASDAQ. So yeah, I'm watching that very closely.
Yeah, that one really puzzles me. And the other component, copper sitting on that 12-year trend line. I think lumber's on a 10-year trend line. Those two indicators are really concerning. And of course, oil made its top back in 2008 and continues to make a series of lower highs and lower lows. So as those continue, that concerns me more and more.
Yeah, I put up a gold chart. I thought you might be interested in seeing it.
Yeah, I've been aggressively talking about gold for about 3 weeks now. On GLD, on the weekly chart, it made 3 weeks where it had lows, which was the lowest volume going back to 2016. So all of a sudden it went very quiet as it was building this most recent base here. But I'm seeing the yen breakout, which is supportive of gold. I'm seeing the TIPS bond ETF breakout, the inflation protected one, and that's typically trends with gold. The gold miners are starting to outperform the metal. There are a whole bunch of things that just made, pay attention kind of moments, but they all seem to be breaking out together.
Yeah, and if you remember, the gold shares was in the winter position on that diagram I showed you right at the beginning of the presentation.
Yeah.
The thing which impressed me about gold, I mean, I haven't had a chance to really look into it in great detail today with today's action, but I see the volume in the last couple of days has really begun to pick up.
Yeah, there's definitely some volume hitting it, and I think on Friday gold was up 1.3%, and the miners were up 3.9%. So they were moving 3 times as fast as the metal. So that's exciting.
Yeah, I noticed the gold shares had a lot of volume too. I put those up.
Yeah. Well, Martin, thank you for taking the time to show us your charts this month. Lots of good data there. I agree with you. So many of them are sitting tricky right here, but a lot of my stuff suggests we're rolling over lower. So we'll obviously next month time will tell us more, but it looks risky here.
I think you're right.
So, hey, thanks again, Martin. We appreciate your charts, and we'll catch you the first part of July. Thanks again.